When choosing between ETFs and mutual funds, consider your investment goals, time horizon, and risk tolerance. Evaluate the cost considerations, including expense ratios, trading costs, and tax implications. Decide whether you prefer passive or active management styles and assess your liquidity needs, including the importance of intraday trading. By considering these factors, you can make an informed decision that aligns with your investment strategy. Valuation techniques are used to determine the intrinsic value of financial assets, such as bonds and stocks. Understanding these techniques helps investors make informed investment decisions by assessing whether an asset is overvalued or undervalued. The valuation of bonds involves calculating the present value of a bond's future cash flows, which include periodic coupon payments and the face value at maturity. The formula for bond valuation accounts for these cash flows and the discount rate or yield, the time period, and the maturity period. Let's valuate a bond with a face value of $1,000, an annual coupon rate of 5%, a maturity of 10 years, and a yield of 4%. First, calculate the present value of the annual coupon payments. Next, calculate the present value of the face value at maturity. Finally, sum these present values to determine the bond's price. Using Python, we can perform these calculations efficiently. The valuation of stocks involves determining the intrinsic value, which is the present value of expected future cash flows, primarily dividends. Two common models for stock valuation are the dividend discount model and the discounted cash flow model. The dividend discount model calculates the intrinsic value based on the expected dividend, the required rate of return, and the dividend growth rate. The discounted cash flow model calculates the present value of projected cash flows. Let's valuate a stock with an expected dividend of $3 next year, a required return of 8%, and a growth rate of 5%. Using the dividend discount model, we determine the intrinsic value of the stock. Let's valuate a stock with projected free cash flows of $5,000, $6,000, and $7,000 over the next 3 years, and a discount rate of 10%. Using the discounted cash flow (DCF) analysis, we calculate the present value of each projected cash flow and sum them to determine the stock's intrinsic value. This method provides a comprehensive valuation by considering future cash flows. Valuation methods for bonds and stocks differ in approach. Bonds are valued using the present value of future cash flows, including coupons and face value. Stocks can be valued using the dividend discount model (DDM) for dividend-paying companies or the discounted cash flow (DCF) model for a broader analysis of projected cash flows. The DDM is ideal for stable, dividend-paying companies, while the DCF is versatile for various cash flow scenarios. Using Python, we can perform a combined valuation analysis for both bonds and stocks. This code example demonstrates how to valuate a bond using the present value of future cash flows. Apply the dividend discount model (DDM) for a dividend-paying stock and use the discounted cash flow (DCF) model for broader cash flow analysis. Visualizing and comparing these valuations provide comprehensive insights into the intrinsic value of different financial assets. Valuation techniques are essential for determining the intrinsic value of bonds and stocks. Bonds are valued using the present value of future cash flows, while stocks can be valued using the dividend discount model (DDM) for dividend-paying companies and the discounted cash flow (DCF) model for a broader analysis. Integrating Python into these valuation methods enhances accuracy and efficiency, providing valuable insights for informed investment decisions.